your thoughts on what we've seen. Like Samantha mentioned in the intro, when you compare the levels we are at today in terms of private sector credit to where we were, say, September 2009, it's down about 5%. And we've seen the impact of AMCON coming in to bail out the banks, but we still see very little in terms of little growth in the sector. What are your thoughts on what's responsible for this?
Well, I mean, with regards to the growth figure itself, I think you need to bear in mind that almost about 2 trillion of credit was sold to AMCON. So the 5% is not generally a like-for-like figure at all. I think there has been definitely a slowdown, even including for that, though. That's clear. The reason is the banks are still trying to adjust to today's realities. Right. You know, they've really recently reinforced their risk systems. They're trying not to make the same mistakes that they made in the past. So they're being very careful as to who they extend credit to. So I think it'll take the banks some time to get comfortable. Also, we had an election process that slowed down. A lot of corporates making a lot of long-term decisions. Those are starting to come back. I'm very confident that credit growth will return to Nigeria.
Well, you know, we've seen this credit growth really moderate. I mean, for the lack of a better word, it's really been quite slow, to be honest. And the thought is, investors were buying banks because they lend. You know, the potential to lend and to make money from lending is really the reason why you're buying these banks. Now, obviously, with what we've seen with the rescued banks and on the secondary market, we've seen those banks come down about 20% recently, and we've just seen that entire sector seems to have really been stuck in the whole news about September 2011 deadline for recapitalization. How do you invest in this environment?
One thing I would say, it's very interesting. Long-term, Nigeria is a real strong growth story. In the near term, it's a rate story. The most important thing you have to look at Nigeria is what's happening to NIBOR rates. NIBOR rates are at 15% today. If we go back a year ago, they were less than in high single digits, 6-7%. So think about a highly liquid bank like a Zenith. Think about what it's doing on Treasury this year versus last year. It's doubling its money on Treasury. So you are going to get a lot of profit growth in Nigeria this year. True, credit growth will be slow initially, but that's going to pick up very fast. What you're going to see in the second quarter and third quarter are very big ticket credit items. You're going to see a lot of corporate extension of corporate credit. For example, there was Etisalat, there was Heineken. You know, there have been a lot of big ticket deals that the big banks are doing, and you will start seeing that in their numbers. Make no mistake about it. But what you won't see is strong growth in retail, because we're still adjusting our risk systems to today's reality. The governor has asked them to use risk-based pricing models. They're introducing those models. It'll take time to get comfortable on the retail side and the small SME side, but they will come through. With regards to the distressed banks, our opinion has always been and will always be, you do not invest in them. They are not on their own going to grow. They need consolidation to grow. The reflection of their share price performance is a reflection of the reality that that's looking harder and harder. But to the shareholders, the main shareholders of those banks, I will say that if they do not consolidate, they will be the big losers in Nigeria.
We'll talk about the prospect for the rescue banks in a second, but one last point on lending. Obviously, Nigeria has GDP contribution from agriculture at about 40%, but the sector continuously starved of bank credit. To what extent can we turn that around? Because we see countries like Kenya where I think the balance is at least definitely more in favor of agriculture.
CBN has done a great job with the agri-funds that it's on lending to the banks basically to support agriculture. I think that's the first important step. But agriculture itself needs to become more conducive. You can't do small-scale agriculture and ask for big-scale loans. What we need is organized, large-ticket agriculture that can appeal to the banking industry, that's more commercial in its outlook and its structure. I think that's more approachable to the banking industry. The banking industry is not set up to do small-scale agricultural support. And if you look at the GDP, that is small-scale household domestic agriculture, really. That's replicated household by household. That doesn't work. What we need are much bigger farms. We need much more commercial farming in Nigeria. And that is more investable for the banking community.
That'll take time to...
That'll take time.
Pick up. Okay, quick point on the prospect of liquidation of the rescued banks. The September 2011 deadline has been set. Seems finally we're going to get to the end of this. It's been about 2 years since the central bank intervened in these banks. But the big question for me is, what's the impact? How scared should we be of the prospect of liquidation?
I think there are two groups here. I think clearly we have a governor who has made it his single most important objective is to protect depositors. He has said that always. I will protect depositors, and he has done so. I don't think that primary group, the depositors, have to be worried about a liquidation. I think the governor will step up to the plate and support them. Now, the second group, even within the sector, if you look at these guys, these distressed banks have become so much smaller than they were 2 years ago. What you're having now in Nigeria is a polarization of the sector. We've got very big banks and we've got very small banks. Retail deposits have moved. Government deposits have stayed, but retail deposits have moved to the big, solid institutions, your UBAs, your First Bank, your Zenith, your GTBs. That's where the deposits are. So there's no real contagion risk here. It's going to be relatively simple to protect depositors. Now, do you protect shareholders? No. The big losers in a liquidation will be current shareholders. And these same shareholders who are frustrating the sale process will be their own losers. If these banks want to move forward, they must be sold so that they can be part of a bigger entity and grow again with a new brand. It's very clear to me, if they do not step up to the plate and agree these sale terms, they will probably be liquidated, and rightfully so.